In general, your real estate investment and even real estate rental investment activities are going to be considered passive and passive losses. But there are a few exceptions to the rule. And this is important because if you qualify for one of the exceptions, that means losses like massive depreciation on a thing called a building could flow through your tax return and offset your W-2 or other type of non-passive income. My name is Paul Vazquez with Tax Lab, and you need to become an ethical millionaire. So, what are these things or these options that you may or may not qualify for that overcomes this general rule that real estate investing, real estate rental activities are going to be considered passive activities, and any losses could then only offset income from that or other passive activities. How can we overcome that? Well, there are, I think, four different options. Let's go through them and see if I counted right. Number one, if you make under $100,000 and you and you do some participation, meaning that you're picking renters, you're assigning who does the cleanup, you're acting as a property manager for your rental, you make under $100,000, you can deduct up to $25,000 of those normally passive activity losses against your earned income. It's an exception. It's right there in the code. I went over it in an earlier video. Next, and the biggest to try to qualify for, is the real estate professional. Here there is many tests, one of which is that you can't have a larger portion of your income and time spent on anything else. So you're not going to be considered a real estate professional as far as this tax code is concerned if you have a main job and you're working real estate on the side. No, real estate's got to be the main thing. And not only does that have to be your main thing, but nobody else can be spending more time on the real estate than any other person. Now you can kind of group things together. There is a grouping rule which allows you to kind of group multiple real estate investments together, but still not one person can spend any more time than you. So there's lots of these little tests that you have to try to qualify for in order for that to happen. And so for the majority of you, it's not going to happen. And not only does that qualification have to be there, you have to have proof. You have to be able to show it. So most of you are not going to qualify for that one, but there's still 1 1/4 option. So maybe it's like a 3.25 rule. So what's the other one? Well, let's just say Fire Marshal Bill. No, nobody. Okay, I'm dating myself. Let's just say that you are running a business and you need an office. Right? I'm in the home office right now, but we have another office. That's where I see all the clients. The clients come to that other office. Now, what I can do is own that office separately, right? If you're smart, you put that inside your trust. Your trust owns that office. You own the trust. Now, you also own this business that can then rent from that. And this is what's called a -4 election. It has to be done in the first year where you're actually renting from yourself. So the first year that this occurs, where you have real estate and then you begin to use that real estate for your business. then you can do what's called this dash 4 election. You really need a professional to help you with that because it's got to be reported in multiple places in a certain way. But now that allows you to then have any passive, what normally is passive activity losses that you can't take, count towards your active income activity. There's another. That's right, another one. It's called the short-term rental loophole. And that means that not one person can spend more than, I'll have to look at the rule. I remembered correctly, 7 days. So nobody can stay longer than a week. Not any one person or group of people can stay more than a week. That means they could do 7 days, and then that's the last time they're going to rent there for the season, for the year. But you could have another renter come in, a short-term renter come in for the next 7 days. It just can't be the same person. So this could be kind of like an Airbnb type thing, but you can't. You must materially participate, and you still have participation rules, meaning you have to spend 500 hours or more during the year. Nobody can be contributing. You have to beat everybody else on contributing time by 100 hours. So it has to be a substantiality in this. It's not just a short-term rental that you passively have. You have to also participate. And then there's like the 0.45, the quarter one, which is what's called the Augusta rule. That's for your own home, but you're really not writing off anything more than the fair rental rate for your own ballroom of your grandiose mansion that you have, because that's what this is really about. It's about you not using the Marriott ballroom to host your annual gala or gala. It's that ballroom that you have that you're going to be using, and you're going to charge your business the fair rental rate for that gala. And you know, it's not something you want to abuse, because those who have been denied that by the IRS tax courts. So those are some options for you. You have to, of course, qualify for these, and I think the easiest one to qualify for is the income one. And then the second is the self-rental one. But outside of those two, and you know, the Augusta rule-ish, you're not taking depreciation. You're just getting fair rental rate for that time period. Besides those three, the other two, you start off with this time and really tracking and really getting into it. If it's legit, it's legit. If that's what you do, that's what you do. But you know, it has to be there, and there has to be good numbers. It has to be good tracking. If you have real estate holdings and you want to see if you qualify for one of these prestigious tax loopholes, as you might call them, Lab Tax Advisory Services, and maybe you could be taking those passive activity losses against your active income. Ooh. Best thing is that you have the income. Okay, just be happy. Maybe you have to pay some extra taxes for all the money you're raking in, but it's best to get the money and pay a little taxes than to not have those funds at all. So don't let the tax benefits be the reason why you take on a financial responsibility. I wish you guys all the success.